Good morning, everybody. Welcome to the Options Trading for Income Weekly Update for January 5th, 2015. Happy New Year. Before we get going, we would like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that there is a significant risk in trading options, and please be aware of all those risks prior to placing any trades. Also, please note that we are using hypothetical computer-simulated trades during the presentation that are believed to be as accurately represented as possible. However, actual results may vary. If you're watching this on some other venue, come on over to our website, check out our programs, the M3, the Bearish Butterfly, the ROCK, the M21, our group coaching, and our Trading Triangle programs. And join our mailing list, get your free reports, 7 secrets to becoming a successful trader, and of course you can sign up for this free weekly webinar. And stay tuned for our programs that are currently under development. Okay, let's take a look at what's going on in the markets. And if you remember from last week, my thoughts were that the NASDAQ would probably come up and try and test for new highs and reverse over. And when that happened, this reversal would probably cause a failure in the breakouts that we've seen in the Dow and the NASDAQ and the SPX and the Russell. It didn't quite go as high as I thought it would. I thought we'd probably get a little bit more out of the NASDAQ, but we did get that turnover. We did get the break in the failure in this breakout as expected, and we got that on all of the other indices. So essentially what happens, usually when you get a breakout failure, that tends to be bearish. Not a surprise that as soon as we had this failure day, that we'd come down to our next most significant support level, which happened to be right around high 1180s, around 1190. So all that's to be expected. Typically, a failure of a breakout tends to be bearish, tends to mean that we are going to continue down. Now, that said, the market has been irrationally bullish for quite some time, and I certainly wouldn't be surprised if we hold these levels or even bounce back up to the previous highs. It wouldn't be a terrible surprise, but from a pure technical standpoint, this is going to tend to be bearish. From here, because of the possibility that we may get a breakdown, hopefully I'm hoping that the market does actually stay a little bit more bullish than it should, and we hold this range. That would be nice for our January trades. At least hold this level for the next week or so. So, today with futures are down, wouldn't expect to see us try and retest down here. And like I said, with the bullishness of the market, I'm thinking more we stay in range than we break down, at least immediately. Although I wouldn't be surprised to see the breakdown either, and realistically that would be more technically correct. So from a position standpoint, where do we stand? Let's take a look at what's going on. First, we have our January Bearish Butterfly. This position here, if we go back to Monday morning, last time we talked, and you will see at that point we were 2/3 entered. And we're entered at the 1200s and the 1170. On the 21st, I probably should have made an adjustment on that Friday because we were over our maximum delta limit, or we were pretty much at our maximum delta limit, I think, on Friday. But I forgot about going into expiration guidelines. So I went ahead and I took care of this on Friday. And essentially what I had to do is I had to scale into my 1220s, and I had to get out of the 1180s. And that put us in a position that looked like this on by the end of Monday. So we're in the 1200s, we're in the 1220s. I brought our delta down to like minus 300. I mean, that's perfectly fine for being this far from expiration. I mean, we're not that close yet, and that's relatively close to minus 250. So that's generally going to be fine. And this is what we look like here on Monday. And let me see if there was anything else with that. No, that was it. So from there, no further adjustments were required. And if we just come to Friday, towards the end of the day, we look something like this. Now we are a little bit sensitive. If the market breaks down, in other words, it has a significant failure of the 1190 level, that doesn't hold. This is the losing scenario typically for a bearish butterfly. So, the difference between the original bearish butterfly that I initially started trading years and years ago was you didn't have these delta theta rules, you didn't have these expiration rules. And, if that was the case, we would have been in the 1200 1180s, and of course the pullback, it would be able to handle virtually any pullback. We added the delta theta rules to deal with grinding up markets, and it makes the trade from a win-loss ratio standpoint much, much better in the more bullish environment, especially the environment we've been facing for the last couple of years. However, the downside to doing that, right, everything has pluses and minuses. The downside to doing that is when we get these fairly large up moves, and we start making these delta theta rolls, and we go into these expiration guidelines. The downside to that is the specific situation where we get a grinding up move, and we pop into expiration guidelines, and the trade draws down, and then we get a harsh down move. That will cause a loss in the trade, where originally that wouldn't have bothered anything. As a matter of fact, originally that was your jackpot scenario where you made these 100+% returns on, in a single month. That doesn't happen anymore with these new guidelines. But it's just a trade-off. It's just a trade-off. So if you are trading this live and you're a more advanced trader and you want to take market opinion into consideration, you can kind of let these hang a little more negative delta and take advantage of these situations. Although, like I said, this may turn out perfectly fine, but this is the scenario where it creates a problem. So we'll see how this goes. All right. So that is the bearish butterfly. Let's take a look at our next trade here, which is going to be the January rock trade. So I'm going to go back to Monday once again, show you where we stood in the rock trade. Let's see. So if you remember, we started this thing out as an M3. We outran the M3 trade. We did our entry test. We said, hey, it's time to go into rock position. We went into the 1190, 1230 rock trade, started getting too much delta, ended up adding in one of these 1250 butterflies. This position was fine for the week, except until Friday. So if we come to Friday at, I'm just going to go to 1500, so before any adjustments here. If we come to Friday, actually at this point of the day it was okay, but multiple times Friday we are over the plus 100 delta, which is the maximum downside on this. We don't allow a whole lot of positive delta into this trade, and there multiple times during the day we're significantly over our 100 delta number. See here we are earlier in the day, we're like plus 173. What I decided to do here is at 1500 we were actually over, at 15 or 330 we're actually significantly over our positive delta again. I pulled our 1250 butterfly off to bring us to, that brought us to just under positive 100. So realistically I had the choice of staying in this position here with minus this one butterfly at 1250, which would put us at a position that looks like this. Right, I could have stayed in this position here, or if I do pull that off and the delta remains too high, then we push back into what we call cat position. Now, I was thinking the market's probably going to stay up, in which case this would have been the better position. However, because of that, and I was kind of on a gray area on whether I should kind of stay in rock position or roll back to a cat position. We haven't seen cat position in, probably a long, long time. So I decided just to roll this back into cat position, which was really, like I said, it was a gray area of the rules. This is actually the safer of the two choices. So this being a safer of the two choices, this is what I chose to do. and this puts us in a position that looks like this. And what we're doing here, if the market comes down, we move into what we call an M3R position. If the market goes up, we come back into our ROCK position again, and we can continue our trading the way we were previously. But if nothing happens here, realistically, 10% profit would be good. So unless we get pushed back up into ROCK position, in which case we'll go for the higher profit target again. But realistically, be somewhere between 10 and 15% would be probably what we can expect in something like this now. And that's the position we're sitting in now. We have new delta numbers. I don't know, remember if you've, which I'm not going to go over here. They're different for every configuration, and this configuration has its own set of delta numbers. So that's the ROCK position. And I just have a comment, yeah, doing a session on the old bearish butterfly rules might be a good topic for group mentoring. Yeah, we could probably do that. That'd be good because they work extremely well, especially in when the market gets really volatile, and certainly during market crashes. So, all right, so that is the bearish butterfly for January. I'm sorry, that's the ROCK trade for January. And like I said, so far so good. Let's see here. We have the January M3, so let's kind of take a look at that. So if we come back pre-adjustment on Monday, we look like this. I'm having a volatility issue. In other words, I'm positive Vega. I could have arguably rolled this. I did not. Actually, yeah, okay, I did not. I was able to fix this with verticals. So if we come to 1530, I was able to do 1170, 1180, 5 of those. This is what we look like. Ended with 5 verticals here, 5 verticals to the 1190. I'm minus 69 delta. And that's as of last Friday, right? So let's go to Monday. By the end of Monday, we have our short strikes all the way up to 9 and 1. So actually, no, I did do the roll-up last Friday, right? So I must have missed that. I did the roll-up last Friday. By the end of here, we're at 9 shorts on the 1200s. Let's see, that looks okay. I have a deviation from my notes, so let's see what happened. This is going to be a surprise to me also. So we are outside our tent. We're under minus 50 delta. We are, 9 shorts at 1190, 1 at 1200. Let's go to Tuesday. Right, we're minus 54 delta here, but we're at the edge of the tent, so that's perfectly fine. Go to Wednesday. I don't think there should be an issue here because the market's basically down from here. So that position's the same, and coming into Friday, there shouldn't have been any adjustments on Friday either. No, so that's perfectly fine. And let's show the T-log. Let's do that. So here's our T-log here for the January M3. I'll back it out a few days in case you've missed what happened before. We had a lot of movements in this one. I think we had to have a rollback early in the trade, right? So, and then of course we're rolling back up again. So this is essentially the January M3. I should show you the T-log for the ROCK trade as well. T-log for our ROCK trade looks like this. So we had the ROCK conversion. Let's just go to the beginning. We entered on the 17th. Did some adjustments on the 22nd, the 23rd. Did some verticals on the 24th. Made a somewhat major adjustment on the 26th. And did this work on the 2nd, and that's pretty much where we sit. And let's see, T-log for Bearish Butterfly is here. Again, not a lot for most of this trade because the market went down. Then, of course, we had the crazy up move, major adjustment on the 24th, fairly significant adjustment on the 29th. And let's go to, and that's it. That's what we have for those. Let's go into the January V-condor, which essentially had no adjustments. Let's see. And it's just sitting here. It's up about $3,000. Should be a good month for the January V-condor. This is what we look like here from a position standpoint. And if we roll back into here, we will start pulling the V out and should be able to hold a fairly nice profit with this unless the market really, really crashes down. Should be, in general, a pretty good month. And that is it for our January trades. Now, the February trades, there were no adjustments on anything, so I'll just kind of show you where we sit. So our February M3 is down slightly. We're a little bit positive delta, and the position looks like this, which is just a really nice, healthy-looking position. We have our January, February Bearish Butterfly again. Let's take a look at this. This looks like this. So let's take a look at what happened there. Oh, because I'm on January, that's why. Let's go to February. That's going to make a bit of a difference. February Bearish Butterfly. There we go. I was pretty sure this didn't have any adjustments this week. If we look at our T-log, we've got nothing. We entered on 26th. This is up about $1,000 because the market's been down, so looking very nice. And let's see, what else do we have in February? We have the February V-condor, which again has had no adjustments. So that is where this one stands. This one is actually pretty much at break-even still. We just kind of entered it, so no big deal there. And that's the way we sit. So everything looks good. The trade I'm most concerned about is the January Bearish Butterfly. We're not sure how that one's going to make out, but the rest of them look really good. So so that's the trade. So I'll just a question here is, for the call in the February M3, what strike do you look for in regards to how much time value there is in the call? And do I still look for a call with a time value of $2 or less? The actual value of the call that we're going to buy is going to be a little bit dependent on the volatility. I mean, if I go into a February, if I look at my February M3 trade, let me see when I entered that. That was on the 26th, right? So let's just stay here. Generally, we'll talk some pluses and minuses here. I mean, if generally the volatility is really high, sometimes you end up with time value in calls like forever, right? So in other words, I could come all the way down to this 1120. I could probably go down to 990. Before I get down under $2, I'd have to be down in the 990 range. Just because when the volatility is high, it tends to throw time value into calls way deeper in the money than normal. So that being the case, I have to kind of balance off how much I'm willing to actually put into the call versus how much I have to pay for it. So normally I like to be in the 90, 91 range. I usually like to be definitely under $5, and usually at least under $3. And if I can get under $2 and still be near 90, 91, 92, then I'm pretty happy with that. This is a case here where they happen to be pricing stuff this way. So that being the case, I kind of have to balance off as how much money do I really want to get in this position versus just sucking up and paying for the extra time value. So here I paid for the extra time value. Realistically, if I wanted to do 10 butterflies, I would have had to come all the way up into here, and I would have been around $13, $14, $15 for time value, which I definitely don't want to pay 13. I mean, that's just too much for me. I'd rather come deeper in the money, add some butterflies in. And the extra butterflies are going to help offset, theoretically, depending on what happens in the market, but usually they're going to help offset my time value number because now I have more profit potential in trade. So that's typically the way I look at it. So there's not a definite answer because the market conditions are different and the way they pump time value in these are different. Like I said, a lot of times I can get into a 90 delta call, which I strive to get around 90. If I'm concerned about a down move, in other words, I think volatility is going to come up, I might go for the 80 delta call. So if I'm in an extreme low volatility environment, I'm near the top of a trend, and these are pretty cheap, I'm going to push to 80 because when the volatility increases, I'm going to have a big expansion in time value in that call, and that's going to really help offset my downside losses in that call. So I'll tend to do that. If I think the market's grinding up, I'm going to tend to go deeper in the money, pay less time value because I don't want that drag happening. So, I mean, realistically, you don't have to make those judgments because the trade system works out fine. But if I'm just looking to eke a little bit more performance out of this or to be a little bit more resilient towards my opinion, that's how I would move it. Okay. Let's see. My next question is the best scenario for an M3 a market that just does nothing for 2 months, or is the best scenario for M3 a market that... Okay, I'm sorry. The question came in like 3 times. So let me... This is basically the best scenario for an M3. So what I would like to happen is usually in an M3 trade, considering this, if the market does nothing for 2 months, what's going to tend to happen is this, say it stays right here, over time this delta is going to increase. As a delta increase, you're going to add verticals to shave the delta number off. Essentially, an M3 works really well pretty much in the same situation a bearish butterfly works pretty well. And that's where the market shoots up to probably 10 points over the long strike. You make some minor corrections if needed. Sometimes you don't even have to, but then it kind of wanders back down. So it wanders back down maybe to this 1185, 1190 level. So, a situation with normal market movement. So you have a normal trend. If you catch the trend, like if you have a price chart and you're getting this kind of normal movement where you're up and down, up and down, up and down, up and down, if you can catch this, somewhere in this side part of the trend where you're not on the bottom, but you're kind of like halfway up the top, and you get to the point where you really don't have to roll anything up and don't have to make any major adjustments, and then it kind of pulls back, and then it stays normal, right? This is not normal, right? It blasted off to the upside, but then it kind of stays in a normal type of a thing where you're a little bit flatter. Then that makes it for a very, very nice M3 trade. Or even if you catch it here, say you catch it here, the market shoots up into here, and then it's going to back down and stay sideways for a while. That's probably the best scenario with that. Yeah, the last 3 days of the rally, the RVX started to rise. One of the things you probably noticed, like last week, Wednesday, particularly Wednesday and early Friday, the RVX was way up, and that's not anything that's that unusual for the end of the year. A lot of the participants don't really know what's going to happen. We're at all-time highs, and they're a little bit nervous of a fairly large pullback, so they're buying they're buying puts to protect their positions into the new year. Not that uncommon to get some really weird pricing towards the end of the year. I had all these positions here were drawn down significantly on Wednesday, and coming into the end of the year, which is you just kind of have to ignore to the extent you can. If you're at your maximum loss numbers, you have to be responsible and do what you need to do. But in general, if the trade's just kind of normal, you kind of have to just ignore stuff like that. It's not. It's just pricing games that are going on with the market makers and the institutions trying to outdo each other. So you just kind of have to let that go. But yeah, usually if the market's rising, the RVX is rising significantly, there are players in the market that are concerned about the market coming down. So generally, that is a bearish sign, definitely. Okay, so January M3 with an 1170 fly. I'm currently positive delta. Do I need to be concerned about the right side of the tent about this? I mean, if you're in the 1170s, how'd you get to, let's see. Yeah, I mean, I'm at 1172, right? So, I mean, no, I'm sorry, I'm at 1180. Oh, you're at 1170. So 1170, your long strike is at 1220, your positive delta. How much positive delta are you? I guess that's the bigger question. I mean, if you're just a little bit positive delta, I don't know that I worry about it too much. If you are way positive delta at that point, I have to wonder why you are positive delta. 10 positive on a 10 lot. So that's going to put you, yeah, so if your T plus 0 line looks okay, you can look at adding maybe another butterfly at 1170. I'm assuming you have 10 butterflies, that's why you're positive delta. So you can just look at adding another butterfly here at 1180, see if that kind of flattens you out a little bit. And that might do that. So you know, of course, if we're up significantly today, I don't know if I'd bother, but you know, certainly if we kind of hang around this area and you're concerned about your delta, because realistically, a volatility increase is going to correct the delta in this. I mean, a volatility decrease will correct the delta. A volatility increase will tend to make it a little bit worse. But yeah, adding another butterfly there would probably be a decent move. Okay, I think that is all the questions. That's where we stand. We have 2 more weeks in January. Or not quite 2 more weeks, but looking forward to seeing this expiration end. It was kind of a pain in the neck all around. So positions should do fine, though. They're actually, like I said, they're in decent shape. So have a great week, everybody, and we'll talk to you on Monday.